You're kind of more in my camp after reading all your notes. You said that in the past, it's pretty amazing that the average time between the last hike and the first cut, I mean, they always seem to go a little bit too far and find themselves reversing. And it's much quicker to reverse a hiking cycle than it is a cutting cycle. We stay at zero forever, but on the way back up, you know, they sometimes overshoot and have to make up for that.
If you look at the past 14 monetary policy cycles, Joe, that's the case. The average is about 4.5 months. My point here is that the Fed could reverse course, history tells us, quicker than the market is expecting. And in this case, I think it's because we're in recession next year, and the NAREU, which is, of course, the non-accelerating inflation rate of unemployment, is higher than it has been historically. So we're probably going to get an unemployment rate that moves from, it was 3.5% a month ago, now it's 3.7, probably going to hit 5% next year. It could even be higher, 6, 7. So if that's the case, by the end of next year, if we're in recession with an unemployment rate that's showing a shedding of millions of jobs, potentially the Fed could certainly move quickly, history tells us, and start to cut rates. The only factor here we also have to consider is the balance sheet, which they're currently rolling off. So that comes into play as well. Your
terminal projection is 5%, and that's even after what we heard yesterday from Bullard and others.
Yeah, they'll probably go to at least 5%.
At least
inflation
5,
is
7. 7, do you think is possible, or was that just? I'd say that too. I mean, you could have said 12. You can say whatever you want if if you're uncomfortable with the recent rebound in the market and you see some of these retail sales numbers that are strong. The coincident economic data may not be as relevant as the stock market to these guys and gals. They may see financial assets doing really well, and that can be self-fulfilling. So they want to maybe nip that in the bud, but they can always point to some of these strong economic numbers, Friday's unemployment numbers. They can point to those and say, yeah, we need to go higher, but I'm not sure they really know because there's a lag effect.
There is a lag effect. 6 to 12 months is the lag effect, and probably by the mid of next year, we're going to be feeling the real effects of the Fed's tightening cycle, which of course has been aggressive. But if you look at economic models, people don't really talk about the Taylor rule anymore. It's not used as much, but the SAM rule, and if you look at the Barringer curve, these models at least give us some input. If you were to look, for example, at the Taylor rule, Joe, we should be at 775 at least. So that's some input. But I think the Fed knows, and they're not, articulating this in their economic projections, but they have to force a recession to get the unemployment rate up and to curb the demand side of inflation, which in my view is the most pernicious and the one that causes wage price spiral, which is the situation we're currently in. Demand for labor is forcing salaries higher and forcing the cost of goods and services higher as a result.